Now, in this topic, we're going to look at one will be the financial assertions that an auditor uses to verify the financial statement, the financial assertions. Also, we look at the subsequent events. And these subsequent events are known as the post-balance sheet events that have occurred after the balance sheet date, but before the AGM. And then also we'll evaluate the going concern of a company. And this means whether the company will be in operation for the next few years or in perpetuity. So the going concern, we look at what are some of the procedures that we undertake. Also, we look at the company audit. Meaning, so this is the audit of banks, audit of insurance companies, also the cooperatives and as such. And then also we look at the concept of the analytical reviews, and then the management representation. Management representations also will be here. Now, this is a very examinable area under audit. So you need to understand these concepts of the financial assertions, subsequent events, also the going concern and the rest. So to start us off, we'll start with the financial assertions. And these financial assertions, these are defined as what the management is claiming about the financial statements. So for example, in this case, the financial assertions means the implicit claims that the management makes regarding information contained in the financial statements, So, for example, by them preparing the financial statements and including the assets of the company, let's say something such as land, they are making an implicit claim that there exists such an asset. That is what you're saying, the financial assertions. And these financial assertions can be categorized into either assertions about account balances. So this is assertions about the account balances that we see in the financial statements. For example, the statement of financial position. Also, assertions about classes of transaction. And events that occurred, And then thirdly, the other classification is on the basis of assertions about presentation and disclosure. Now, this assertion helps the auditor to formulate audit procedures on the specific items that he is to carry out an independent examination on. So for example, the assertions about account balances include, so these are assertions about account balances. So in this case, these are the implicit claims balances that the management makes about the account balances. So one of them is what we call the existence. Now, for this one, it means that the management is making an implicit claim that the assets that are shown in the financial statements actually existed as at the balance sheet date. So that is what you're saying, that the assets and liabilities existed or actually existed as at the balance sheet date, Now pay keen attention to these assertions because they formulate the audit procedures, as you will see, as at the balance sheet date. Another assertion that is there in this case is what we call the rights and obligation. and obligations. Rights and obligations. So this is who has the rights to either an asset and the control of an asset, and what are the obligations that are imposed on the liabilities that the company has. So that is what you're saying. So this is either the right to control an asset, to control assets, and obligations on the liabilities, And how do this influence the auditor's procedures? For example, in an audit of, let's say, the asset that we had taken, for example, land, to verify the existence of this, an auditor will physically inspect this asset. He will go and visit the piece of land, physically inspect this. So as you can see, such an assertion will help the auditor to formulate the audit procedures with reference to the financial statements. And then under rights and obligations, on the other hand, if you want to verify such an item, you will look at the document of title, For example, the title deed will tell you the right to control such an asset. So this is the assertions about account balances that you're saying in this case. And then the same case, we have the valuation. Now for valuation, on the other hand, is the items in the financial statements are reported in the correct amounts. That is what you're saying. Items in the financial statements are reported in the appropriate amounts, So this is the what you're saying. So for example, in the case of valuation of the land, you will engage someone who is called a valuer to value such a land, so that you verify what is in the financial statement is actually the value of the piece of asset that you're investigating. So that is on the basis of the account balances. And then lastly is on the completeness. So completeness dictates that everything that should be in the financial statement has actually been included in the financial statement. So that is what you're saying, that all items have been included in the financial statements, So that is on the assertions about account balances. The second one will be assertion about classes of transactions and event. The assertions about classes of transactions and events. And these ones, generally, they are more or less the same as the ones for account balances, but differ in aspects such as, one, the transactions actually occurred. So that is on the basis of the occurrence. So what this assertion says is that the transactions actually occurred and they pertain to the entity itself. That is what you're saying. So the transactions are and events actually occurred. And they pertain to the entity. So how would you verify this? This means, for example, if you're auditing, let's say sales, you will look at the sales invoice in terms of the dates and match them with the respective good dispatch notes. That is what you're saying on the occurrence. You're going to see how this influences the audit of these specific items. Now, the other assertion made by the classes of transaction is on also completeness, which you have said that all the transactions have been included in the financial statements. So that is what you're saying. All transactions have been recognized. All transactions and events have been recognized, have been included in the financial statements. Now, when you're carrying out audit procedures on specific items, you will see that these assertions really guide you on the same. And then also on the basis of accuracy. So this means that all the transactions have been recorded appropriately in terms of the amounts. That is what you're saying. So transactions and events have been recorded appropriately. Transactions and events have been recorded appropriately, Now, for example, if you were to audit, let's say an item such as a motor vehicle, to verify the accuracy, one, so you have the cost of this motor vehicle. To verify the item being shown in the financial statement, one, you will recalculate the depreciation of such an item, recalculate the depreciation so that you know the accuracy of this item being shown in the financial statements. As you can see, such an assertion helps to formulate this audit procedure that you have to recalculate the depreciation of such an item. So, and then another assertion about classes of transaction will be on the basis of classification. Now, classification means that they belong in the correct class of accounts. For example, if it is an expense, it is recorded under those expenses. If it is an asset, it is under the assets, not liabilities. That is what you're saying. So that the transactions are recorded in the correct class. Transactions are recorded in the correct class, For example, if you are to verify this, let's say you take your auditing sales, you will trace the sales invoice in the ledger so as to verify that it was actually posted in the correct place. That is the classifications. That is what you're saying. And then also on the basis of the cutoffs. Now for cutoff means they have been posted or they have been accounted for in the correct accounting period. The accounting period, that is what you're saying. So they have been, transactions have been recognized. Transactions have been recognized in the correct accounting period. Now, this is very important because the audit of the financial statements has to have the financial year that they are carrying out the audit for. So the correct accounting period can be verified in different ways. For example, if you're auditing, let's say the purchases or the sales, you can take a sample of invoices, and match them with the good received notes or good dispatch notes on a month-on-month basis, just to see the relevance of these invoices or the accounting period that they have been accounted for, which we will look at. So this is on the assertions about classes of transactions. And then the last one is on the assertions about presentation and disclosure. Assertions about presentation and disclosure. So this dictates that every item that should be disclosed has actually been displayed in the financial statements. So the first one is that occurrence, on the basis of occurrence, like we have said. So we have said that occurrence is that, so everything that should be in the financial statement has actually occurred and pertained to the entity. So that is what you're saying, the displayed or disclosed events pertain to the entity, And then secondly, in this case also, the completeness and disclosure, completeness and disclosure, that all the items that should be disclosed have been disclosed in the financial statements. So that is what you're saying, all disclosures have been included. Disclosures have been included in the financial statements, in the financial statements. And then thirdly is on the basis of accuracy and valuation. Now, for this one, it says that all the items that have been disclosed at appropriate amounts. So the financial information disclosed has been disclosed in appropriate amounts, disclosed in appropriate amounts. This is very important because of the users of the financial statements, appropriate amounts. And then lastly, will be on the basis of classification and understandability. So that is saying that the items have been classified accordingly to the correct classes of accounts, and it is easy to understand those disclosures or presentation. Now, I want you to write this mnemonic somewhere. It will really help you in formulating these audit procedures. Always remember this mnemonic, even when you're doing your paper. So to have all of these assertions in mind or in memory, we usually say, so this is the mnemonic that is there. So any audit procedure that you will come up with, most of them are likely to fall under this. So this one is on accuracy. The other one is on completeness. The third one, it can be either cutoff. You can use cutoff. You can use also classification. You can also use, this one is on occurrence. This one is on valuation. This one is on existence. And this one is on rights and obligation. Now, all your audit procedures, most of the items that you'll be examined on, the procedures will necessarily revolve around this. And to just show you how that happens, let's take an item such as in the audit of non-current assets, and see how we can actually formulate these audit procedures. So, for example, the audit of non-current assets, such as, let's say, audit of non-current assets. So this brings about the concept of how you verify these items. So this is all under the vouching and verification. Vouching and verification. So I'm just going to leave this here so that we can compare the audit procedures that we come up with with that one. So, for example, in the case of audit of non-current assets, so we have said one, on the basis of verifying what? The existence. So this is how you will be asked, what are some of the audit procedures to undertake in such a case? And then you have been given a case whereby, let's say you have been given an asset such as a motor vehicle or such an item. So on the basis of this existence, one of the audit procedures, so the audit procedures, we have said, for example, land, the audit procedures, you will go to physically inspect the item, inspect this item. Now, so this is just one of the procedures that are formed in this case. The other one will be on the basis of, let's say, rights and obligation. For the rights and obligation, on the other hand, this one you will examine the document of title. That is the, for example, if this item is land, you look at the title deed to know who controls this asset. That is what you're saying. So you will inspect the legal document, and then necessarily they bought this item, let's say if it is land or the motor vehicle, from someone. So for you to know who controls this asset or who we are to pay the obligations, you can communicate with the third parties, and that is what we call circularization. And this means you communicate with the third party for them to confirm either the information is true or disagree with that. So you can also circularize to the third parties who sold the company this item to know the obligations. Circularize to third parties because necessarily they bought this item from someone, third parties. And then also you can review any correspondences and inspect the supplier invoice, inspect supplier invoice, inspect supplier invoice. And then another key procedure that you should always have in mind, always in any audit of an item, always have this point there, that it is, you have to obtain written management representation. You have to obtain written management representation. And what are these written management representation? So this is information regarding the aspects of the organization. So for example, in the verification of this control, the control over the asset, you will need to have explanation from the management. So also obtaining written management representation is another audit procedure that you will use. Now, another item here would, let's say, pick the valuation. On the basis of valuation. So for valuation, we said in a non-current asset, we can have the cost, and the cost, because this is the amount of money that we use to buy this, how then can we come up with the audit procedures for this? One, we have said that this item was necessarily bought, so we can inspect what? The supplier invoice, so that we match the cost with that of the invoice that we are seeing. Inspect supplier invoice, supplier invoice. Also, you can consider the market prices of such an item. Consider market prices, so that you know if what is stated is actually reasonable. Market prices, market prices. So this helps you to know the value of the asset. And then on the basis of the depreciation. So one, in this case, you can discuss with the management the depreciation policy, discuss depreciation policy with management. And the company may either be using which kind of depreciation? It can either be straight line or reducing balance. So that will help you to evaluate the value of this item as at now. And then on the basis of this depreciation policy, also another key audit procedure that is there, most of the items when we discuss on the ICS, one of the control activities that we stated in this case was on authorization and approval. Now, another hint of how to formulate these audit procedures is that this kind of authorization happens when the directors meet in what we call the board meeting. The board meeting, and a record of all of these items discussed here are recorded in the board minutes. So you as an auditor, in any item that you are going to audit, if it required any form of authorization, you have to have a procedure that we call you review what? The board minutes, review board minutes. No, so now you have two major points that are usually in these audit procedures. One, you should always obtain the written management representation. And then this form of authorization makes you to review what? The board minutes for most items that you're going to be asked in form of auditing. And then you can recalculate the depreciation, depreciation among others. So, and then on the basis of revaluation, you will still review what? The board minutes, because for an item to be revalued, it has to be discussed in this meeting. That is what you're saying. Also inspect board minutes, board minutes. So this is how you form the audit procedures in this case. And then consider any assumptions that were made, the reasonableness. Consider assumptions made. Assumptions made. Now, on the last part will be the acquisitions or disposals. Acquisition and disposal. What is one of the procedures in this case? One, you will review what? The board minutes, because if you remember correctly, when you're saying one of the controls over the fixed asset was that any acquisition had to be what? approved or authorized. So that is one of the audit procedures that you will state there. So you will review the board minutes, board minutes, among others. So this is on the basis of how to form audit procedures for these items that you're saying here. So, and then on the basis of completeness. So that is why audit is said to be a process, because it relies also on the controls that we stated in the ICS. For example, one of the controls of a fixed asset is that you should maintain what? A fixed asset what? Register. So for you to verify items that should be included in this fixed asset register, you are testing on the completeness of that item. So you will inspect the fixed asset register, because we have said the completeness states that everything that should be stated in the financial statements should be included in the financial statements. Now, that is one of the items that we may audit, or we may audit in this case. So what if we want to carry out audit procedures on the impairment of these assets, or any impairment of that case? For example, impairment of even intangible assets such as goodwill. Now, so for the impairment basis, you can look at September 2021, question 1B, September 2021, question 1B. So September 2021, question 1B. Sorry, September 2015, question 1B, Roman 2. Should be September 2015, question 1B, Roman 2. So you're being given there a case study on that note that you're told. So the case is about a company that you need to carry out an audit. So that question reads, question B, 1B, Roman 2, explain the principal audit procedures to be performed on the impairment of goodwill. Now, so the impairment in this case, one of the things you have to understand is that we recognize impairment the lower of the recoverable amount and the net realizable value. So in this case, you will be looking for indicators of impairment, the indicators of this impairment, and they are impairment, and they are categorized into two. So one is what we call the internal indicators, and this may entail if the company or the asset in itself has lost value or has become obsolete. It is no longer relevant. That is what you're saying, internal indicators. So for example, so this one may, if the asset has become obsolete, also there's discontinued use of the asset, let's say, of the asset. So this is just a basic indicators of impairment that you would look out for. Also in the case of this physical damage of the asset, physical damage. Now, on the external indicators, on the other hand, this one you look at the market value, the decline in the market value of this item. If it has decreased in terms of the market value, so the decline in this of any negative changes in the economic value, negative changes in economic value, So these are some of the aspects that you'll be looking for in any case of impairment of an asset. So for example, this one is on tangible assets and tangible assets. So the audit procedures, in this case, audit procedures, so according to these assertions that you're saying here, one of the items that you look at is, one, the auditor should consider any indicators, of impairment. These ones that you're saying, impairment. So this is just highlighting a few things of how we audit this. Then we'll brush over the other items also. And then also, he should consider or request the management for review. So if impairment has taken place, he should request the management for review. He should request management for review, the review. So this review is to enable him to ascertain these assertions that you're saying here. For example, the accuracy of this impairment that has been made. And then if no review has been done, he can suggest the importance of having one. If no review has been done, he may discuss with management, the need for one. And then also, if the management refuses, he can qualify the report. So if they refuse, qualify the report. So that borders on this concept of the accuracy of the item that you're showing in the financial statement. And then also, he may also recalculate or verify the value in use, of the asset, verify the value in use of the asset. So what do you mean by value in use? This is the present value of the cash flows of this item that will bring this kind of cash flows. So it is the present value of the future net cash flows expected from the asset in itself. So verifying the value in use, this is to ensure that we have the correct kind of accuracy of the amounts that we are showing in the financial statements. So I want you to think on the lines of these kind of assertions when we are looking at, so that is on the basis of impairment. Let's say you want to verify or conduct audit procedures on investment properties. What are some of the procedures that you would have? For example, to verify the existence, you will do what? On this investment properties, you will physically inspect these assets, and then on the basis of the rights and obligation, you will inspect what? The legal document. So I told you these ones will really help you. Also inspect the document of title in this case. And then on the basis of valuation, you will verify the cost of those items, the investment properties, and also you will recalculate the depreciation on the same. Recalculate the depreciation. So these audit procedures, they majorly, they fall on these assertions that you're saying in this case. And that is what you're saying on the basis of the investment properties, Now, we also have assets that we call the held for sale assets. So for this held for sale non-current assets or assets, these are assets that are to be sold or that are necessarily to be sold. They are more profitable when sold rather than having them. So what are some of the asset audit procedures that you will conduct in this case? One, you will do what? And to verify the existence for this sale of assets, you will physically inspect the assets that you're saying in this case. Also, you will confirm the asset meets the definition of the held for sale asset, and confirm that this held for sale asset has been valued at the correct amounts, that you're saying. So these audit procedures border on the concept of these assertions. And then always, I told you, you will obtain what? Written management representation. Always obtain written management representation to explain these assets, to explain the assets that they bought. Now, on the basis of, so this one is on the audit of non-current assets. That is what you're saying. So for you to understand this, you have to have these assertions with you so that you can be able to formulate the audit procedures on the same. Now, we have instances where you may audit intellectual properties or intangible assets. And what are intellectual properties? In this case, intellectual properties are concepts such as patents, also trademarks, along also the copyrights. So when auditing these items of the intangible assets, so these intangible assets can be defined as those assets that cannot be necessarily categorized as tangible. So intangible assets. In this case, the intangible assets include concepts such as goodwill, patents, or intellectual properties, among others. So in the audit of goodwill, so the other one was on the impairment of this goodwill. One of the things, so I want to show you the similarities that we have in these audit procedures. So we necessarily have two types of audit of goodwill, which we call the purchased goodwill, and the other one is non-purchased goodwill. So this one is the one that has grown due to the company, purchased goodwill and non-purchased goodwill. So under this audit of goodwill, the audit procedures that are there, remember, if it is a purchased goodwill, it means that we had to have a meeting to acquire such a business, and that meeting is the board minutes, board meeting. So to get this authorization, you will have to review what? Review the board minutes. Like I told you, review the board minutes. Any aspect that required a form of approval, it will be best for an auditor to review any board minutes that were there. Also, you can recalculate the goodwill. And what is goodwill? Goodwill is defined as the difference between what? The purchase consideration and the net assets. So you can recalculate the goodwill. And which assertion are we verifying in this case when you recalculate the goodwill? On the accuracy of the amount being shown as the goodwill. That is what you're saying. And then also ensure that the valuation of this goodwill is reasonable. Ensure valuation of this goodwill is reasonable, is reasonable in this case, is reasonable. And then another aspect is, in the case of impairment, you can check the impairment review. And then also you can do what you call agree the consideration, the purchase consideration to the sales agreement, So in other words, this means the amount that you paid for is what the purchase consideration shows. You agree with those. And then in the case of audit of intellectual properties, properties, intellectual properties. In this case, on this basis, so we are saying intellectual properties include concepts such as patents, copyrights, and also trademarks and trademarks. So how then can you verify these intellectual properties in the financial statements that are being shown? So one of the procedures that you conduct, also another key type of procedure is that if there involves many items, let's say such as trade payables, account payables, trade payables of the account receivables, you will have to obtain a schedule or a list, obtain a schedule of all intellectual properties, obtain a schedule of all intellectual properties. So this is to verify what? This is to verify everything that needs to be in the financial statement has been included, the completeness of all the items that should be included. That is what you're saying, intellectual properties. And then you can examine the written agreements, so that you know the value of these items that are stated. Also, another thing is you can do is you can circularize with the commissioner of this, circularize with the commissioner of intellectual properties, The reason why you're doing this is to verify also the existence of these patents. So circularizing means you send out confirmation by the commissioner of intellectual properties. And we have two types of circularization. It can either be positive or negative confirmation. Now, the difference between these two mainly, for positive, this is whereby you send out information so that they agree or disagree to the stated information or disagree. On the other hand, the negative confirmation is whereby, so they are to reply, if they disagree. So if they fail to disagree, to reply if they disagree. So if they fail to reply, it means that they agree with the information. They agree with the information that is stated in that case. And then also, you can review the incomes generated from this. Review the income generated from this, generated from the intellectual properties. Now, the importance of this now is to verify the kind of revenue that you have gotten from the intellectual properties, for example, the royalties and such. And then also obtain written management representation, So this is a very key point in these audit procedures of this kind of audit. Now, we have instances where an organization may decide to undertake research and also start projects. So you as an auditor, you will be called upon to audit these costs that have been incurred. And that is on the audit of research and development costs, Now, this one was actually even tested in November 2019. Question 2C. So you can review these questions also during your free time. We will cover some of them in our blogs also. So this is just to make you understand how they are being asked. November 2019, question 2C. November 2019. So in this case, you're told explain the matters you will consider to determine whether this, so you have a case there of Maisha Bora Services Limited. Then you're given it is a case about a company with different KPIs from the draft and actual. And then part C, you're asked, explain the matters you will consider to determine whether the capitalized development costs are appropriately recognized in this case. So one of the things that you will ensure is that you have a schedule of all the research and development costs. Obtain a schedule of all the research and development costs Secondly, in this case also, you will inspect the minutes for the board, inspect minutes of the board. And why are we carrying out this inspection of the minutes of the board? To ensure that these research and developments were what? Authorized and approved. Also, thirdly, you can check the accounting records. So we check the accounting records to ensure that this project was clearly defined in these accounting records. So that is what you're saying, check the accounting records, and that related expenditure has been separately identified. And then also check to confirm that the research cost has been expensed. Check to confirm that the research cost has been expensed to the income statement, income statement also. These are some of the procedures that you can use also. And then also, you can review the calculation of the future cash flows of the project. Also, confirming the feasibility. You can confirm the feasibility and viability of this project that was probably to be undertaken. Feasibility and viability. So this one entails you can consult by consulting with experts. So this is the use of the work of an expert. Now, before you place reliance on this work of an expert, one, you have to check on the competence of the expert and the qualifications that he has on such an issue. So that is what you're saying in that case also. So that is on the audit of such items. So for development costs, they have to be properly recognized also, and it's on the basis of the completion of such an item. So, and then let's say now we decided to audit current assets, audit of current assets. For example, current asset that is normally also asked is on the basis of, let's say, inventories. On these inventories. Now, just to see how this question can be asked, you can look at May 2021 also. May 2021, question 4. May 2021, question 4. May 2021, question 4A. May 2021, question 4A. So you're being told that you have a company there that part of their inventory was defective in nature. So what are some of the, so Roman 2, discuss the auditor's responsibility and the audit procedures and actions that should be carried out in this case, that should be carried out in the event that there is this company that you have questions about the inventory. the inventory. Now, one of the aspects that or the audit procedures that you'll carry out for inventory to verify this, you will still use these assertions that I'm telling you here. So on the basis of existence, you will physically inspect the stock, and be involved in the stock take, and be involved in the stock take, So that is on the basis of this existence. That is what you're saying. Also, on the basis of the rights and obligation. Now, this calls upon your understanding of the ICS, of the purchases and sales, because as you can recall, under purchases and sales, we discussed that we had the sales cycle and the purchases cycle, in which we had the LPOs and also the goods received notes. So to know the stock, who it belongs to, you can inspect the purchase invoice, inspect the purchase invoice, and inspect the purchase invoice. Also, you can verify this. You can match the invoice with the goods received note, match the invoice with the goods received notes, and also the LPO that you raised when you're purchasing this item. That is what you're saying. And then also, we say that for purchases, you have to have a list of all the purchases invoices. So on the basis of completeness, you can inspect completeness. You can inspect the final stock sheet, inspect the final stock sheet, also, that you know the kind of inventory that is left. And then also you can always obtain the written management representation. Obtain written management representation. So these are some of the audit procedures that you'll conduct in an audit of inventory. So again, do not forget these assertions that we are saying in this case, because they will help you to formulate these procedures necessarily, because you are going to have to confirm them. So let's say for the basis of the cutoff, so this is what we call the cutoff tests. You can perform these cutoff tests in this way. So one, you can pick good dispatch notes for a few days before and after the year end and match them. So pick the good dispatch, a few dispatch notes before and after the year end, and then you can match them with the relevant invoices. So you can match them with the relevant sales invoices, just to see when they were recorded in the system. That is what you're saying, because cutoff states that the transaction should be posted in the correct accounting period. That is what you're saying. So you can trace these invoices to confirm, trace them to confirm they were posted, trace the invoices in the ledger to confirm they were posted in the correct, accounting period, That is what you're saying in this case. So that is on the cutoff tests or inventory, cutoff tests for inventory. Now, the reason why we conduct these tests on inventory is that these stock may be easily manipulated. This is one of the high risk areas that we have to pay keen attention to in terms of the audit. And then also we audit what we call the construction contracts. And now these construction contracts can be evaluated on the basis of completion. So you have to recalculate on the percentage of completion to verify the kind of accuracy that you're saying. And also you can review the contract from the same and recalculate the profits recognized. And recalculate the profits recognized. And then on the basis of the contingent liabilities. So these are specific high risk areas that I am mentioning that you have to formulate these audit procedures. Now, these contingent liabilities, these are obligations that the company may necessarily pay in the future due to past events. So this is one of the aspects that the organization may end up paying in the future. So this kind of obligation calls upon the auditor to carry out certain kind of audit procedures. Now, the audit procedures for these contingent liabilities is, for example, let's say a case that is in court that deals with the company. We may have to pay those individuals compensation in the future. So what does an auditor do in this case? One is that he obtains a list of all the contingent liabilities. So that means that he has a list of all the liabilities that should be there. That is to verify what? The completeness of the item that you are auditing, that everything has been accounted for. That is what you're saying. And then also, because this item is not necessarily determined, we do what we form what we call the provisions. We make a provision for this kind of obligation. So as a means of verifying this, the auditor may recalculate the provisions on the basis of understanding the accuracy of the contingent liabilities that have been shown in this case. And then also obtain an analysis of the movement of these provisions, obtain an analysis of the movements in provisions. What this means is that you see if there's an increase in provision or there's a decrease in the provisions of these contingent liabilities. And also, you can consider the likelihood of reimbursement. Will they be reimbursed this amount? Consider the likelihood of reimbursement of these items that you're saying. So the auditor has a responsibility of coming up with these audit procedures. And then also, he can consider the nature of the client's business to know the likelihood of contingent liabilities that will be formed. Consider the nature of the client's business, So this is some of the audit procedures that an auditor may take into account. So that is what you're saying. And then also, on the basis of this one, so also the auditor may obtain what? The auditor may obtain written management representation. To understand how these provisions are made. Written management representation. So, and if specifically these contingent liabilities are in a legal case, one of the things he can do is that he will want to get the facts of the case so that he knows the likelihood of them to pay. Also, he will discuss this with the company lawyers, to know the likelihood of paying that amount, and also obtain written management representation and the reasonableness of the assumption made. Reasonableness of the assumption made. So what, for example, I want you to look at May 2016, question 1. May 2016, question 1A. So this is on audit work on trade receivables, on accounts receivable. Accounts receivable, May 2016, question 1A, Roman 1. A Roman 1. So you can try and read that case, May 2016, A Roman 1. So I want you to try and formulate these audit procedures that you're saying an auditor may come up with on the basis of the cases that are there. So 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 on a more practical aspect, let me show you how you write these audit procedures in an exam setting. So for example, looking at that question, so that is on May 2016 question. It's May 2016 question. Question 1A. Question 1A. So you're told, in the context of the above scenario, describe the audit work to be performed on the following matters. One is the allowance for doubtful debts for the current financial year is 15 million, which represents 2.5% of the accounts receivable as at 31st December 2015. And then the allowance for doubtful debts for the three previous years was 5% of the accounts receivable. The credit controller has advised that the reduction in allowance was due to the measures undertaken to improve on debt collection and credit check procedures. So that is the one that I want us to deal with. So that is on the audit work on trade receivables, trade receivables. So this is how you answer. You first of all evaluate those aspects that you're told in this question. One, so they created an allowance for doubtful debt, which they reviewed over time. So an auditor, first of all, will discuss on the basis for which these provisions are to be created. So one will discuss with management, on preparations of account, account receivables, and also account receivables and provisions, and the provisions. On what basis do they make these provisions and the provisions? And the provisions also obtain an analysis of these provisions, obtain an analysis of provision for bad debts, provision for bad debts, and the assumptions arrived at coming, or explanations on the basis, for which they are calculated, So remember, this is now trying to understand this concept of the obtaining an analysis of the provision for bad debts, how to monitor these bad debts. Is it based on aging of the trade receivables or the aging of the debtors? That is what you're saying. And then also, if the bad debt provision, that is what you're saying, if the bad debt provision is based on age listing. Also, the listing must be tested. The listing has to be tested. So this is on the basis of how do we make provisions for bad debts? Is it according to how long this person has not paid their debts, the aging of, or also those debtors, and how they make those payments? Also, remember at this point they said that the credit controller has advised that the reduction in allowance was due to the measures undertaken to improve on debt collection. So also the auditor can obtain an explanation from the credit controller as to why this provision has changed. Also obtain an explanation from the credit controller as to why the allowance for doubtful debtors changed, as to why the basis for calculation has changed. The basis for calculation has changed. So this one will enable him to understand why these provisions have changed over time also. And then also perform analytical review procedures to determine whether the change in the basis is appropriate. Perform analytical review procedures to determine whether the change in the basis is appropriate. And these analytical review procedures, we defined these as, these are computation of the accounting ratios and trend analysis and the cross-sectional analysis, and carrying out reasonable checks to verify the items in the financial statements. That is what you're saying in this case. And then also examine whether the aging of receivables has improved over the year. Examine whether the aging of receivables, has improved over the year, years. So this is just some audit work that the auditor may do approved over the years. That is on the basis of this audit evaluation. So if you are to read Roman 2, the director's emoluments amounting to 70 million during the year have not been disclosed in the financial statements. So the audit work to be performed in that case is, first of all, you'll want to understand on what basis do we calculate the director's emoluments. Also, the reasons why they have not been disclosed in the financial statement. So that is on the audit work to be performed on the trade receivables on that note. And then, so the same case applies now in the case of an audit of trade payables. First of all, you will obtain a list of all the trade or the creditors of the company and obtain a sample of the invoices, or also the creditors, a sample of the creditors, and circularize them to know the balances. So in the audit of these trade payables, on the other hand, so just think of this basis of the assertions that are there. For example, to verify that there are actually existence of these trade payables, you will want to obtain a list of all of them, and also it also banks on the completeness of the trade payables, that you have shown all the number of the creditors in this company. So one, you will obtain a breakdown of trade payables. So this one is to verify the completeness of the items. Also, secondly, you will select a sample of these creditors. Select a sample of creditors, a sample of creditors, and circularize them. I've told you circularization is communicating with those third parties to confirm the balances. Circularize them. So that is to enhance the accuracy of the amount that is showing that we owe them. That is, if they confirm that this is your debt, this is the amount that we owe them, owe them, then we can verify the items in the financial statements also. And then also select a purchase of, select a sample of invoices. Select a sample of invoices. And inspect them. For example, on the dates, also the approval, because one of the controls we said under ordering is that for orders to be made, they have to be approved or authorized for buying of this commodity. So you will inspect them for the dates and authorization on the same. That is the audit of these trade payables, and then also agree these purchase invoices to the goods received notes. Agree purchase invoices to the goods received note. And then also you can perform cutoff tests. So the same kind of procedures apply for other items such as accruals, whereby you will obtain a list of all the accruals and the prior year balances, so that you review how these accruals have been treated over the years. And then, so that is on the basis of this auditing of these items. Also on the audit of leases. So we have two types of leases. We can have the financial, and the other one is which one? Operating lease. Now, the audit of leases is, first of all, you will inspect the property. The lease property. And which assertion does this come back to? To existence of the property that you have leased. Also, another thing is that you will obtain a copy of the lease agreement, And what is this lease agreement? What is this assertion? It's on the basis of the rights and obligations. You see, they are all coming back to this concept. So it is important for you to have that. And then also, you can recalculate the interest, calculate the interest. This now comes back to the verification of what? The accuracy of the amount that you have shown also. And then check to see if the lease has been classified correctly. So that comes back to which assertion? Classifications of these items. So that is basically it on the audit of such items, the audit of those items. Now, the other thing that you have to know is that how do we recognize revenue in this company? Now, in the case of revenue recognition, that is an auditing standard number 18. So we recognize either the sale of goods. So this is on revenue recognition. So we can either recognize, so revenue recognition happens in 3 ways. Revenue recognition of sales, recognition for sales, for sale of goods, So in this case, we only recognize a sale of good if either of the parties have met their obligations. For example, they have started to make payments of this. So that is what you're saying. One, the entity should only recognize revenue in the case that it has completed its part and the seller has substantially fulfilled his part of the obligation. Also, the risk and rewards have been shifted or transferred to the buyer, and that the entity has no continuing management over the goods and services entities in that case. So that is on the revenue recognition of sales. And then the other one is on the revenue for tendering of rendering of services, So this is IAS 18. So this is for you to know of how we recognize revenue in this company. So this may become an audit procedure in that if the item necessarily has been recognized, it should meet this criteria, for example, for in case of audit recognition, audit procedures. So, and then on the basis of royalties, revenue, so this is revenue for rendering of services. It should be based on the stages of completion of these services. And then revenue on interest, revenue from royalties, interests, and dividends, So to evaluate this revenue, so for example, royalties, revenue is to be recognized on accrual basis, And then for the interest, on the other hand, it is on the time basis. Interest is on the time basis. And then also, the other one is on dividend. It should be recognized when shareholders approve. And the shareholders approve in this case. So in the audit procedures for this now, revenue recognition for the specific items, for example, for the revenue from sales, the auditor may determine whether the criteria for recognition for sale has been met. For example, what you're saying that sales are to be recognized when the risk and rewards have been passed to the buyer. Also, they can verify the measurement of this revenue and match the sales invoice with the goods dispatch note, and match the sales invoice with the goods dispatch notes that you're saying in that case. So on the verification of this verification of sales, actually this question was even tested. So you can look at November 2020, question 3B, November 2020, question 3B, November 2020, question 3B. So you are told, describe 6 audit procedures you will carry out to verify sales of Synergy Limited. So the first one, so in that case, so that is November 2020, question 3A. Question 3A. So this is how you answer such a question. First of all, the recognition for sale has to be met. The definition for recognition of such a sale by Synergy Limited has to be met. So one, determine whether the criteria for recognition has been met. Determine whether the recognition, or the criteria for recognition, has been met. The criteria for recognition has been met. And that means it has met this revenue recognition that you're saying has been met. Secondly, also, you can obtain a breakdown of the sales on a month-on-month basis. Obtain a breakdown of the sales on a month-on-month basis. So this is to test also the cutoff a month-on-month basis. And then you can select a sample of the invoices. Select a sample of the invoices and inspect them for the dates or for dates and also authorization. Also, you can match these sales, match the sales invoice with the good dispatch notes, in this case. And then also you can trace the invoices to the ledger, That is to ensure that actually they were recorded in the right account. For example, this matching the sales invoices with the goods dispatch note is to verify that what we sold was actually what went out, and then trace the invoices to the ledger. So that is on the basis of everything that should be included in the financial statements has been included. And then also you can perform the sales cutoff test, whereby you take a sample of the invoices on a month-on-month basis to verify that they are accounted for in the correct accounting period. Also, you can verify the measurement of this revenue. Verify the measurement of revenue. On what basis have they measured this revenue? Measurement of the revenue. So those are some of the procedures that you would expect for sales also. And then from revenue from rendering services, you can review the contract and also the billing and obtain a breakdown of the total cost and estimated costs to completion. On the basis of the revenue from the interest and dividends, You can obtain a schedule of all the financial securities and verify the existence with the investments and circularize with the brokers, So also, we can audit what we call the government grants, and this one was actually asked also in a previous year's question paper. So the audit of government grants. So this is grants given by the government. So you can open your question paper also, May 2019 question 4B. May 2019 question 4B also. May 2019 question 4B. Question 4B, May 2019 question 4B. Also, so this one was on the basis of the audit of grants, of the grants also, government grants. So one of the things that you should have in this case also, so this is on the government grants. So one, you will obtain all the documentation, relating to the grants, obtain documentaries or documentation relating to the grants, Secondly, also, you will confirm the conditions for recognition have been met. Confirm conditions for recognition of a grant, for it to be a grant, has been met. Confirm conditions for recognition have been met. And then also, you can agree the value to the documentation. Also agree the value to the documentation, agree the value of the grant. Agreeing means you confirm, agree the value of the grant to the documentation, And then to verify that this grant actually reached the organization or on occurrence, you will inspect the bank statement, because necessarily the grant has to be reflected in the bank statement. So also agree the receipt of the grant, that they received the grant receipt, to agree the receipt of the grant to the bank statements, the bank statements in this case, and review any assumptions made. Review any assumptions that were arrived at. Assumptions made. And then also, as usual, you would obtain written management representation. So this is some of the audit procedures you would refer to. And then in the case of borrowing, you will review the loan agreement, and that loan agreement will give you on the basis of how much the amount they were given. Also, you can verify the payments to the records of the bank statement and as such, and this kind of instance. So where an entity changes its accounting policy, let's say what we had said for the depreciation, if they change the from the straight line to the reducing balance, one of the audit procedures that you will carry out will be on the reasons for change and why the change in accounting policies, changes in accounting policies, in these accounting policies. So for this one, this is what we call the IAS 8. So this, one of the things that you will look for is on disclosures of the reasons for change, also the effect of this change on the financial statements. So one, you will look at if this disclosure is adequate for the financial statement, and then discuss with the management for reasons of the changes in the policy, and establish the extent nature of that change. And on the cases of the employee benefits, you will request the directors to reconcile the schemes of the asset valuation and review any assumptions made and obtain written management representation. Now, necessarily in auditing of these items, a key thing that is always asked, it is always asked a lot, is the audit of accounting estimates. Audit of accounting estimates. So very first, you can look at November 2019, question 3B. November 2019, question 3B. November 2019, question 3B. November 2019, question 3B. So you're told, November 2019, question 3B. So you're told the preparation of financial estimates involves significant subjective judgment and opinion. Many of the provisions made fall within what are ordinarily called accounting estimates. Describe 4 audit procedures required in respect of the accounting estimates. So what are accounting estimates? Accounting estimates are necessarily things such as provisions or provisions of doubtful debts, provisions for bad debts. That is what you're saying. So you make an estimate of an amount. So how then can an auditor carry out an audit of this? So one, you will review and test the processes. Used, review and test the processes. Test the processes for developing estimates. So this is to verify the that it is a reasonable way of developing estimates also. And then also another thing that you will review is any correspondences with third parties. Review correspondences with third parties. And then also, thirdly, so correspondences with third parties mean the communication with third parties. Because, for example, if you're going to make any provision for bad debts, it will be prudent for you to look at the communication between the managers and the debtors to know how much that they are owing the company. And then also consider whether the data is accurate. Also consider the accounting estimate, whether the data, if the data is accurate, and reliable. Also consider whether the basis of assumption is appropriate. Consider whether the basis of assumption, is appropriate. The basis of assumption is appropriate. So that is on the basis of audit of accounting estimates. And then as always, you will obtain written management representation. And you can review the underlying contracts that give rise to this accounting estimates. Obtain written management representation. So this is an area that is highly examinable. As you can see, we have looked at many questions, and it does not stop there. You can even look at November 2020. Also question 5A. This question was still repeated in November 2020, question 5A. You can also look at that, November 2020, question 5A. So this is on the basis of accounting estimates. And we have said accounting estimates is making a provision or an estimate. Also, on that note, so, and then we have a concept that we call the related parties, and related party transactions, Now, an auditor has a responsibility to these related parties transactions because what they entail. So for example, an example of a related party is whereby you have a group of companies. So this means that you have a parent company and a subsidiary. So if this company sells goods to the parent sells goods to the subsidiary, that is what we call the intergroup sales. And this intergroup sales, it should be eliminated from the cost of sales of the subsidiary of the parent, and also the sales of the parent and the subsidiary. So this kind of intergroup sales, the auditor has to carry out audit procedures of these related party transactions. So for example, if this amount was actually eliminated from the accounts of the parent company and also the accounts of the subsidiary. Also, the related parties may include joint ventures, also the associates, so associates, also branches. So the related party transaction now are these transactions between these related parties. Also the directors may fall under these, the directors of the company. So in light of that, you can look at May 2021, question 1B. So this area is also highly tested. The responsibilities of the auditor with regards to the related parties and related party transactions. And how and what are some of the responsibilities that he has. So May 2021, question 1B. May 2021, question 1B in that case. So when you're studying for this audit evaluation and reviews, pay keen attention to these assertions, like I told you. They will really help you to formulate those procedures. Those procedures we were saying. So May 2021, question 1B. So you're given there another case. And then you are asked, so May 2021, question 1B. So you are told, Roman 1, evaluate the reasons why during the course of an audit, the auditor needs to be aware of the existence of related parties. So one of the reasons why the auditor has to be aware of this. So one is that, so the reason is, so that is May 2021, question 1B. So the applicable or the applied financial reporting framework may require disclosure of this applied financial reporting framework. May require disclosure of these related parties, of related parties. So you disclose all the relevant related parties. Also, the existence of these related parties may be affected by the legislations. The existence of related parties may be affected by laws may be affected by legislations. For example, let's say the tax liability of the entity, may be affected by the tax laws. Tax laws. And then these related party transactions may be for another reason rather than for the good of the company. In this case, that is what you're saying, may be affected by the tax laws. Example, in various jurisdictions or different areas, jurisdictions. And then another reason why he has to be aware of the related parties is because of what you're saying. A related party transaction may be motivated by another reason rather than fraud, rather than profit. So that is what you're saying. So a related party transaction may be motivated by another reason, may be motivated by factors such as fraud. For example, what you were saying the other day on the fraudulent irregularities, this is a deliberate act to swindle the company. Then also, the accounting systems may fail to identify this, so he has to be aware of them. Accounting systems may fail to identify related party transactions, or related party transactions. And you've said these transactions include concepts such as intergroup balances or those intergroup sales and as such. So, and then you asked Roman 2, describe the audit procedures that should be carried out to identify the existence of related party transactions, of transactions with related parties. So I want you to go and try that one. What are some of the auditor's procedures in identifying these related party transactions? So that is May 2021. Question 1B, Roman 2. Question 1B, Roman 2. Question 1B, Roman 2. So we will start from here in our next class, and then we will finish up on the subsequent events and the going concern of the company. And also the audit of those specific banks, insurance companies, and as such. So we will answer some of those more questions in that next class. So we'll continue from there.